In February of 2023, a 99-year-old man sat in a wheelchair in front of a room full of investors and said something that made the room go quiet. Nobody was expecting a stock tip or a call on interest rates. He was talking about one habit of mind, the one he believed destroys more portfolios, careers, and lives than any market crash ever could. 9 months later, he was dead. That room in February turned out to be one of the last places on earth to hear Charlie Munger explain, in his own words, what he thought everyday investors were still getting wrong. This video is about that warning, what led up to it, and why it still applies to almost everyone watching right now. Charlie Munger spent nearly 6 decades building one of the most respected investment records in American history alongside Warren Buffett. And for most of that time, he was the quieter one. Buffett gave the speeches. Munger sat next to him and every so often dropped a single sentence that reframed the whole conversation. People started showing up to his own shareholder meetings at a small California company called Daily Journal Corporation just to hear those sentences. By 2023, those meetings had turned into something close to a pilgrimage, with investors flying in from other countries to sit in a conference room and listen to a man well past the age most people stopped giving interviews at all. He wasn't sentimental about his age. He joked about it, mentioned it flatly, treated it more like evidence than an excuse. And in that last full year of his life, what he chose to talk about wasn't a hot stock or a clever trade. It was a warning about the mind itself, one worth understanding carefully, because most people who repeat it online get it slightly wrong. A shareholder asked him what he thought was the single biggest cause of bad decisions, financial or otherwise. Munger didn't hesitate. Denial, he said. Not stupidity, not bad luck, not a lack of information. When the truth gets unpleasant enough, he explained, the mind plays tricks on people and they convince themselves it isn't really happening. That's the warning, and it's a strange one to leave behind. He didn't point at a specific stock to avoid or a bubble to fear. He described a mental process, the one that makes people hold a losing position too long, ignore a business that's clearly deteriorating, or keep believing a plan is working long after the evidence says otherwise. It's an odd final message from one of the greatest investors alive, aimed less at markets and more at what markets do to a mind that refuses to look at things clearly. Sit with that for a second, and it starts explaining almost everything else he said that year. Take his comments on speculation. Munger was blunt about what he saw happening in markets that had nothing to do with careful analysis and everything to do with excitement. He described the trading around meme stocks as reckless behavior dressed up as opportunity, producing what he called wretched excess and genuine danger for the people caught up in it. He wasn't scolding anyone for having fun. He was naming a pattern. People buy something because the price is moving, not because they understand what they own and build the reasoning afterward to justify it. Same denial, different costume. You don't buy a company because you understand its economics. You buy because everyone around you is buying. Then convince yourself you had a reason all along. He was even harder on cryptocurrency. And it's worth being precise about what he actually said instead of the softened version that gets repeated. He didn't call it risky or speculative. He called it a gambling product dressed up to look like an investment, something built to move money from people who don't understand the odds to people who do. He said he wasn't proud of a country that let it spread the way it had. Agree with him on crypto or not, the logic underneath is the same logic behind everything else he said that year. People were participating in something they didn't understand, calling it investing, and never bothering to check whether the label actually fit. This is where it gets more useful for someone managing an ordinary portfolio, because Munger's last warnings weren't only about obvious speculation. He spent time warning about the businesses that look safest. The most famous, most admired companies, the ones that seem too big and too dominant to ever struggle, are often exactly the ones most likely to be overpriced. Everyone already knows they're great, and that's the problem. Once a company's greatness is common knowledge, the price usually reflects it, sometimes reflects more than it should, leaving very little room for anything to go right that isn't already priced in. He pointed to Disney, a company that had once looked unassailable and had, within his own lifetime, gone through struggles nobody would have predicted a generation earlier. His point wasn't that great companies make bad investments. It was that a great company bought at a price assuming perfection is a bet on perfection, and almost nothing stays perfect for long. Every business eventually gets harder to run than it used to be. Welcome to human life, he said. In that same dry tone he used for nearly everything, it's a useful filter if you own individual stocks. Nobody's telling you to avoid great companies, just to separate the quality of the business from the price you're paying for it. Two questions that get merged into one far too often. A wonderful company at a foolish price is still a foolish investment. Munger built an entire career on keeping those two judgments apart, and toward the end of his life, he seemed genuinely bothered that fewer people bothered to make the distinction at all. There's another warning that lands differently depending on who's watching, because it's less about an asset and more about where you're getting your information. Munger talked more than once that final year about people on television and social media promising outsized returns in exchange for a course, a subscription, or a book. Some of these people mislead others on purpose, he said, and it bothered him more than almost anything else in modern finance. Someone already wealthy, he pointed out, has no good reason to teach strangers how to get rich trading unless the teaching itself is the business. If a guru's income depends on you believing you can beat the market, it's worth asking honestly whether that income depends on you succeeding or just on you staying convinced. This connects to something we've covered before on this channel, incentive cost bias, one of Munger's oldest and most repeated ideas. People respond to what they're rewarded for, not necessarily to what's true. And almost nobody is honest with themselves about how often they're the one being sold to. In his final months, Munger seemed to want that message underlined one more time, loudly for whoever might still be listening. There's also a quieter warning buried in what he said about value investing itself, and it wasn't especially optimistic. He told a room full of value investors, people who'd built careers finding underpriced businesses through patient analysis, that the strategy had gotten harder. More people practice it now with more capital, more computing power, and faster information than existed when he and Buffett started out. His advice wasn't to quit, just to adjust the math in your head. Get used to making less than investors did in earlier decades, he said, because the competition for the same opportunities had grown enormous. It's not the kind of line that goes viral. It doesn't promise a shortcut, but it might be one of the more honest things a legendary investor has ever said about his own field, an admission that even a strategy proven across decades doesn't guarantee the same results forever, because the environment around it keeps shifting. Line them all up and a pattern starts to show. Denial, speculation dressed as investing, paying perfection prices for great companies, trusting people whose income depends on your belief rather than your outcome, competing in a strategy that's gotten more crowded than it used to be. Different costumes, same warning underneath. Reality doesn't care what you want to be true. The market doesn't know your account balance, your timeline, or your hopes. It just is what it is. And your only real edge as an investor is seeing it as clearly as you can stand to, even when clarity costs something. That instinct, seeing things clearly even when it's uncomfortable, wasn't limited to money in Munger's last year. There's a small, almost throwaway detail from that same period that says more about the man than any market call could. He mentioned offhand that he'd refused to use a cane as he got older, not out of stubbornness, but because he'd noticed his friends who used canes still fell down anyway. So he switched to a walker instead, something sturdier, something that actually solved the problem rather than just performing caution. Odd story to include in a video about investing, except it isn't really, because it's the same instinct running underneath everything else he said that year. Skip the option that looks responsible in favor of the one that actually works, even when it looks less impressive walking into a room. A cane looks better than a walker. Munger spent his whole life choosing the sturdier, less impressive option over the one that merely looked good right up until the end. He died on November 28, 2023 in Santa Barbara, a little over a month before what would have been his 100th birthday. Friends who spent time with him near the end have said his mind never really slowed down, that he kept reading, kept flipping through pages of stock data more out of habit than necessity, kept looking for the next reasonable idea long after there was any obvious reason left to keep working at all. Later that same year, against the popular mood around environmental investing, he took positions in companies tied to coal, betting that global energy demand would keep it relevant longer than most people assumed. Whether that specific call ages well or not, it fits the pattern one more time. He wasn't investing based on what was fashionable to believe. He was investing based on what he actually thought was true, even when that meant disagreeing with almost everyone else in the room. So what does any of this mean for someone managing a normal amount of money? Without a research team or decades of experience just trying not to make a mess of their own future? Probably a short list of uncomfortable questions worth asking honestly instead of quickly. Are you holding an investment because the facts still support it, or because admitting it isn't working would feel bad? Are you buying something because you understand it, or because everyone around you seems excited about it? Is the price you're paying one that assumes the company stays perfect forever, or one that leaves room for it to just be normal? Who benefits if you believe what you're currently being told? And can you live with smaller, steadier results now if the alternative is risking everything chasing something spectacular? None of that is exciting. None of it will make anyone rich by next quarter. That was never really the promise behind Munger's philosophy, even though a lot of internet content built around his name tries to make it sound that way. His actual message, especially in that final year, reads more like a warning label than a get-rich scheme. Most financial damage isn't caused by a lack of intelligence. It's caused by people smart enough to know better, choosing comfort over honesty at exactly the moment honesty mattered most. There's a detail from that February meeting I keep coming back to. Someone asked him essentially what he'd tell a young investor just starting out, someone with almost nothing yet and their whole financial life ahead of them. He didn't describe a strategy. He talked about expectations, about how happiness in investing and in life generally has less to do with the size of your returns and more to do with the gap between what you expected and what actually happened. Expect too much and even so results feel like disappointment. Expect something reasonable and ordinary success starts to feel like a genuine gift. Strange thing to hear from a man worth over $2 billion, and maybe that's exactly why it's worth listening to. He wasn't telling people to want less out of life. He was telling them to stop lying to themselves about what's actually likely, because that lie is where most financial suffering quietly starts. 99 years old, in a wheelchair, still sharp enough to correct a numbers question from memory, still blunt enough to tell a room of wealthy shareholders to expect less, not more. That was Charlie Munger's last public message to everyday investors, delivered without ceremony, without any sense that this might be one of the final times most of the world would hear him speak. He said what he'd always said, one more time as clearly as he could, and then he went home. If there's a single line worth keeping from all of this, it's the one he gave first about denial. Before you check your next statement, before you make your next trade, before you decide to hold sell or buy something new, ask yourself honestly whether you're looking at the facts in front of you or the version of them you'd rather be true. That question cost Munger nothing to ask and nothing to answer honestly over and over for almost a century. It might be the cheapest piece of financial advice you'll ever get. It's also, by his own account, the one most people quietly refuse to follow. If you found this useful, consider subscribing. There's a lot more of his thinking worth working through carefully instead of shrinking it down to a slogan. And if you take one thing from this video, take the question he kept circling back to at the end of his life. Not what you want to be true. What's actually true, whether you like the answer or not.